In this video, I interviewed a DST advisor to talk all things about DSTs. I'm here with Al Di Nicola of Naples Asset Management Company. Al, thanks for joining us. Please tell us a little bit about yourself.
Hey, great to be here, Ryan. Thanks for the opportunity. I've been in real estate space over 40 years. A lot of it's been in real estate development, large tracts of land, Collier County, Lee County. Got into the securitized real estate space a number of years ago as a result of clients asking us for solutions to their 1031 exchange problems, and
Right.
entered Delaware Statutory Trust. So they've been around about 20 years, but the last 8 or 10 years, I've been focused more on the securitized end of the real estate business.
With the DSTs.
With the Delaware
Yeah.
Statutory
So obviously with the 1031s, please tell us a little bit about what exactly is a Delaware Statutory Trust, a DST, and how does that kind of function as a real estate investment vehicle?
Yeah, it's interesting. Delaware Statutory Trusts have been around for a long time, but it wasn't until 2004 that a real estate firm out of Chicago petitioned the IRS to enable individual investors to utilize Delaware Statutory Trust as replacement properties for 1031 exchanges. So that the genesis of it came back about 2004. So it's only been around for a little over 20 years, but the last number of years has been really a go-to product for folks that are looking at getting out of active management primarily and into passive management. So Delaware Statutory provides that type of issue.
So they act as a replacement property mechanism for someone doing a 1031 exchange,
Right.
but also as a relinquished property if they've already been in a DST.
Oh, absolutely, absolutely. So it qualifies as a like-kind exchange, and of course, like-kind is probably one of the big topics that you have
Within
to
the
deal with.
1031,
every day.
yeah, so-
What is a like-kind exchange? You know, people obviously think that if I have an apartment building, I have to get an apartment building, but that's really not the case. Okay. So the same assets that are in commercial real estate or investment properties are the same assets that are in Delaware Statutory Trust. So you would have apartment complexes, or reference this multifamily. You'd have student housing, senior housing, logistics, warehouses like Amazon Distribution Center. Ford Motor Company has now DSTs that have been established. Recently, there have been a new evolution of life science developments. As we come in onshore, a lot of the medical products that have been produced offshore now are coming back onshore. So now we have a lot of life sciences being done. And also land. Land banking has now qualified as 1031 exchange in Delaware Statutory Trust, as long as you're not flipping the land. You have to hold them for certain
periods. Okay. Yeah, no. So you kind of go into it, so you can see it's a broad range of asset classes that you can invest in with the DST, correct? So you're talking about apartment complexes, but then also the life sciences and land, or in oil and gas industrial properties, correct?
Right. And Ryan, it goes more than just different asset classes. Delaware Statutory Trust enables you to package maybe multiple replacement properties for one property that you're selling. For example, if I'm selling $1 million property that has been located in one geographic area, I may be able to exchange through 1031 exchange to 3, 4 different Delaware Statutory Trusts. I may buy a self-storage facility in Texas. Maybe I'll get a multifamily apartment building in Tennessee, or something in Florida and Nevada. So it enables an investor to diversify. Not that diversification always eliminates risk, it helps to reduce it, but I can go to different geographic areas. So it helps, not asset class diversification as well as
geographic. So
geographic,
huge thing that we always see, even just normal 1031s, when people are looking at real property. The basis of 1031 is, it's a good thing to be able to diversify into other asset classes, but also geographically without any boundaries within the United States.
Right. As long as it's if you live in Illinois, for example, you may want to move your investment out of Illinois or California or whatever. And that's interesting. California probably has more 1031 exchanges than any other state. Well, it's a big state. There's a lot of investment properties there. Yeah, it enables them to get out of the certain geographic area and go someplace else.
Okay.
Yeah, awesome.
No, and with that, obviously that's some of the key benefits that make it a nice option for someone on that. What type of investors are best suited for a Delaware Statutory Trust or for a DST?
Well, I can tell you who is not suited. It's someone who wants to continue being actively involved in their real estate investments. They're not suited. I have a gentleman right now who's involved in the midst of a 1031 exchange. And it was funny when I was talking to him a couple of weeks ago. He says, I'm having separation anxiety. And I said, what is that? I said, is this a personal thing? He says, no. I've owned this piece of property in Brooklyn for 35 years. I've been managing, and it says, I feel like what am I going to do?
Right.
And I says, okay, how old are you? I'm 75. I say, well, maybe you can get out of active management into passive management. But if you want to be an active manager, that's not for you.
Right.
It's also, in order to be an investor in the Delaware Statutory Trust, you need to be an accredited investor.
Okay.
So accredited investor has a financial component to it. You have to have either an income qualifying issue of $200,000 for individuals, or jointly $300,000, or $1 million worth of net worth excluding your primary residence. Okay, so that you have to be an accredited investor. And someone who wants immediate access to their funds, that's not for them. I mean, the Delaware Statutory Trusts are not for them. Just like other types of things, like investing in bonds, is not for somebody who wants to have immediate liquidity. Yeah. Right. So liquidity is not there in a lot of real estate holdings, but also true for Delaware Statutory Trust. Someone who needs liquidity, it's not really for them.
Okay. So is there like a minimum investment requirement in these DSTs that are there for these type of investors? Because, from our end, we see a lot. They either know, yes, we want to go into a DST, that they're putting, substantial amount of money into it. But, we also see as DSTs as some of that, that backup option as well, right? We have some money left over, or even then I need to replace some debt. So can you talk a little bit about how the debt component might come in?
Sure. Now, DSTs, if you're an accredited investor, you don't have to get involved using a 1031 exchange. You can be a direct cash investor. And I do have direct cash investors that, have $50,000, and he says, I really can't buy any real estate. Can I buy the DST? Yes, you can. Normally for the 1031 exchange, $100,000 is typically the minimum. Okay. Now, what has changed in the last couple of years are the large institutional REITs that have, and they're $25, $30 billion REITs that have now identified that maybe they want to get a slice of the 1031 business. So they've taken some of their performing REITs, apartment buildings, out of their REITs, created the Delaware Statutory Trust, and then we'll have, in a couple of years, an UPREIT back into the REIT. Now, those minimums typically are $250,000 to $500,000. But generally speaking, $100,000 is typically the minimum. Now, what you were talking about, money left over,
right?
Not really pocket change, but it could be 40 grand, 50 grand,
Some that they just don't want to pay taxes on. They want to get it. They don't need it. From our end, we see it. They don't need it right away. What can they do with it? What kind of return can they get? And where's the best place to put it?
Right. And so the way that Delaware Statutory Trusts are scaled is that you can stipulate almost actually to the penny how much you want to invest. So if someone had $35,695.22 left over from their exchange, we could get a sponsor who would peel off that exact amount.
Okay.
So what really is important in that, when you dive into that, on the commercial real estate or the investment real estate brokerage side of the business, many 1031 exchange people, around 18 to 20%, overpay for their replacement properties. And the reason they overpay for it, because the seller finds out, hey, in order to qualify for a 1031 exchange, I got to use all the cash. So the negotiations don't really go well, because the seller thinks, okay, the buyer's got to use all the cash. So maybe there's a strategy to negotiate your best deal for in regular traditional real estate that you want to use, because you can bifurcate your exchange, traditional and a DST, and then use the balance and buy Delaware Statutory Trust. So that may help people from the negotiating.
Okay. No, that's all great stuff there. And so with that, kind of working with that, they would work with you, and that's, from our end, we'd put them in touch with you. And how do they go about identifying those type of properties? Do you tell us a little bit about that process, working with them? Like you'll say, here's what's your financial, what are you looking for,
Sure.
where, how?
Yeah. So what we spend time with is on suitability and what people's risks are. So are you going to need money in 3 or 4 years? Well, maybe a Delaware Statutory Trust is not for you. One of the things that you mentioned that the last question was about the debt replacement.
Right.
So the debt replacement really becomes important for people seeking a Delaware Statutory Trust because, as many people know, in order to qualify fully for a 1031 exchange, you have to replace the debt with either new debt or fresh cash.
Right.
So DSTs are prepackaged with non-recourse debt.
Okay.
So if you're coming out of the exchange and your payoff is $150,000 on a loan, we structure that and proportionally in a Delaware Statutory Trust so that you get non-recourse debt to replace that. So how do we do that? Well, if you're buying one DST, we look for what the loan to value of which you've come out of, and we match it up. If you're doing multiple DSTs, then we have a matrix where we partition it against
The value, the debt, different
value.
portfolios.
So how do you identify property is one of the questions you ask. A lot of it has to do with what space people have been in and do they have a comfort zone. I have folks that are apartment people. They've been apartment people all their life. They only want to buy multifamily. Other people have said, hey, listen, I love self-storage. It seems like self-storage has been, it used to be a big mom and pop business, but now it's becoming more and more institutionalized.
Yeah, I think part of it, if I understand, it was mom and pop, then it went to like the tick investments, and then over into more of now you kind of see it more in the REIT DST type.
Yeah, there's more DSTs. So sometimes the self-storage becomes maybe a little bit, I don't want to say recession-proof, but it seems like it's when people are doing well, they buy extra stuff, so they move stuff into the self-storage facilities. Then when the economy goes bad, they move out of where they are. They got to go store their stuff. Right. We as Americans, we store stuff. I mean, I used to own a self-storage facility, and I couldn't believe the things that people kept in their facilities. Yeah. And then the other type of property where people enjoy is sometimes a triple net lease with the credit tenant, whether it's Amazon. I mean, we placed some DSTs with Ford Motor Company built 2 million square foot plant up in the Michigan area for parts, so was packaged as a DST.
Okay.
It enables an individual investor to get involved with tenant grade, institutional grade real estate.
So that's part of what I assume a sponsor looks at when they go and look at these DSTs is, what kind of agreements are in place, who's the tenant, and how, what are those lease agreements and so forth, and that helps solidify whether it's possibly a good DST that you're going to vet, and whether it's one that you would use,
That's right. So in the case of a logistics center, the building may be a $50 million building, but the tenant put in $300 million worth of robotics inside. So sometimes when a tenant spends that much money, the leases are going to be extended years and years and years and years.
Okay.
So we help identify based on, do you have a preference geographically, or do you have a preference asset class wise? So that's where we pretty much start.
Okay.
With helping people identify. And then the other item comes into how much time do we have?
Okay.
I mean, there have been times where I've gotten a call from an investor who says, hey, I have 5 days left to identify my property. And, the 45-day clock is ticking.
Right.
It's, fortunately, a lot of advisors like ourselves, we keep big blotters, big spreadsheets, everything that's available on the market. And we know what the ending balances are. We track it every week of what's available in the marketplace.
Oh. No, very good stuff there. So I can see, obviously there's a lot of benefits to the DST, right? From that. Talk to us a little bit about what are some of the risks that investors might look at within the DST. Obviously we say there's not, any, you just can't pull your cash out. You can't say, hey, I'm ready to get this out in a year, right? That's obviously I would say a drawback, but that's one of the things.
Well, number one in all real estate, liquidity is an issue. When I was growing up in the real estate business a long time ago, we used to have a rule of thumb that if you buy a piece of real estate, it's going to take you around 5 years before we went to crazy acceleration of values, about 5 years to recoup all of your expenses, whether your title costs, your financing costs, your closing costs. So real estate in itself is not a liquid. You can't call your broker up and say, hey, sell my house and give me the money the next close in 3 days. So liquidity is one of the biggest features that, biggest footfalls that, hey, if you're looking for liquidity, Delaware Statutory Trust, as well as other products, are not really for you. Even real estate investment trusts have a quarterly redemption collars, so the trusts don't run out of money. So that's one of the things. The other item would be, in order for you to understand, you should do your homework a little sooner than later. Even though, yes, we can fulfill call it a ticket or an order. We get a call from a commercial broker that says, hey, my guy just finished a $6 million exchange. He's got to replace $2.2 million in debt, and he's already taken $300,000 off the table, where the accountant's going to do the capital gains on the $300,000. So how much cash do I have? And so, I mean, yes, we can handle that, but we would rather start with an educational process ahead of time. My background's been in education, so I try to, make sure I educate people onto, how do you handle those things,
Okay. No, and all good stuff there. So,
But the other thing is the sponsor.
Right.
The sponsor credibility is one of the things that we look at. How long has the sponsor been in business?
Okay.
Some sponsors have been in business 1 year, 2 years, and we attend a lot of third-party due diligence meetings where sponsors are interviewed. Attorney firms are there to question the sponsors on their private placement memorandums, which are typically a couple hundred pages long. So the longevity in the marketplace really is important. Has the sponsor taken any Delaware Statutory Trust full cycle? Meaning, has it sold? If they have sold, how have they done? Did the people get all their money back? Did they make a profit? Did they have a little haircut? Were they able to exchange out of a DST and go into a traditional real estate, another DST, or simply take their money off the table? So we look at the sponsors. We also look at the asset class and where the asset is located. If it's a multifamily property in an area where there's limited job growth, schools are questionable, hard to get to, that may not be on the top of our list to suggest for someone to get into. Yeah.
Okay.
But other areas, we take a look at the underlying real estate components as well. Being in real estate, that's a little easier for me.
Yeah. No, all great stuff there. So, no, we appreciate your time coming out today to talk a little bit about the DSTs there and what they are. So thank you for your time and coming out.
You bet. Thank you so much.
And that wraps up this video. If you have any questions or need assistance on a 1031 exchange or a DST, our contact information can be found below.